Good morning and welcome. My name is Teresa Campbell, and you have joined the Printing Industry Midwest and PIA Mid-America Financial Executives Council discussion on tax strategies for the graphic arts industry. I want to note that all of our attendees are placed in mute mode during this session so that we can ensure a quality recording that will be made available to all of the members following the program, as well as a PDF of the slides. We do, however, encourage you to comment and ask questions during the program by typing in the Q&A field at the bottom of your screen or by raising your hand and we can unmute you. We ask that you communicate any technical difficulties in the chat field and we'll handle those separately. The Financial Executives Council is coordinated by a team of leaders from both regions. They guide the programs and the content offered every other month. It's focused around financial reporting and compliance, data management and security, and financial policies and planning. Our co-council chairs are Carl Nathy from Myers Printing, Ken Rain from Daily Printing, Ryan Wagner from Action Mailing and Printing, and our committee chairperson, Rick Riesgraf with LB Carlson. Rick, I'm going to turn it over to you to get started.
Thanks, Teresa, and welcome everyone. Our topics today are going to be, I hope, some promising tax saving strategies that many in the graphic arts industry can implement and take advantage of. We always have a common enemy there called the tax man. So we have some good ideas and some good topics today. In regard to that, Ben, if you could go to the agenda slide. Well, first of all, I'll introduce our speakers. Our speakers will be Mike Dahlman, and I know he's going to talk a little bit about his firm and his background. He's from McGuire Sponsel, a specialty boutique tax firm, one of the nation's leading specialty firm, dealing with R&D to cost segregation. And joining him from that firm is Kyle Riddle. And Kyle will introduce his background as well. And Rob Yonkers is one of my senior tax partners at our firm, specializing in graphic arts industry and manufacturing. So they're going to cover most of the discussion today. We're going to focus on 6 key areas: research and development tax credits, cost segregation studies, depreciation strategies, sales and use tax, a little bit on the Inflation Reduction Act, and a little bit on the employee retention credit. Before we get started, I just wanted to alert you that the panel that Teresa introduced has an agenda already lined up for the rest of the year. This isn't exactly necessarily the order we're going to go in, but I think it's pretty close. We are going to have a CEO roundtable panel, a discussion on the update and status of the merger and acquisition strategy in the industry, the data and information security challenges that the industry faces and how to tackle some of that, as well as just an overall economic status of the industry. And so those look for additional information to come your way on those. We generally are going to have future meetings every other month going forward the rest of the year. So and hopefully this is the right order we have them in. So with that, I'm going to turn it back over to Mike. And he's going to share his screen with PowerPoint, talking mostly about our research and development credit and cost segregation. So Mike, can you take it from there?
Yes, sir. Thank you, Rick. Let's see, there we go. Is it up big on everybody's screen?
Yep.
Perfect, good. Well, thanks, Rick and Teresa and Ben and Rob for having us. For those of you guys that may not know who McGuire Sponsel is, my name is Mike Dahlman, and we've got a shareholder with the firm, Kyle Riddle, with us as well, who very, very knowledgeable about the R&D tax credit. And kind of really what we're going to talk about today is, how does the printing industry qualify for the R&D tax credit? Kyle Riddle is going to go over a couple of examples of some clients that we do have in the printing industry and how they qualify, and kind of go over the general landscape of what the credit looks like, and then go into some other cost saving strategies with cost segregation, which is a real estate depreciation exercise. So a couple of different tax saving strategies that you guys can talk to LB Carlson with and some of your other CPA firms out there. So with that, McGuire Sponsel is a national specialty tax consulting firm. We're headquartered in Indianapolis, Indiana, where Kyle is right now, and I'm home based out of Indianapolis as well. We got 90 plus employees across. We got 3 offices right now. We'll be opening up another office in Phoenix, Arizona here this spring. And we specialize helping CPA firms across the country with these specialty tax programs that are available to their clients and a lot of the business in the United States out there. So we specialize in cost segregation, which is a real estate depreciation exercise. We help clients with helping them accelerate their depreciation forward so they can realize the net present value of those dollars now instead of waiting in the future. We also do a little bit in the international tax world. What Kyle really focuses on is the research and development tax credit. And we're going to go over some of the qualifying activities, give you a really Google Earth approach to the R&D tax credit. And then we also do a lot of energy saving tax credits in form of 179D, 45L. And our last unit we have is what called economic incentives. And those are incentives available to people who are hiring people, purchasing equipment, purchasing maybe another business to help grow in other markets. There's state and local incentives that are available to those folks out there. And we have a team at McGuire Sponsel that specializes in that. So with that, there's just another overview kind of some of the subpoints that we could help you with in each respective category. And right now we want to kick off the meeting with kind of give you an overview of the research and development tax credit and how you guys might qualify. So with that, the R&D tax credit is a federally sponsored program by the IRS out there that says if a business is attempting to develop new products or make an existing product better, focus on processes, any kinds of techniques and formulas that are out there that you guys are using in your industry, there is a R&D tax credit that might be available to you for all of the expenses that you are plowing toward some of these functions that you're doing out there, whether it's developing a new ink, developing a new printing process, developing a new printing technique that you're using that may help you increase your throughput on, hey, we can print more using this process. So with that, Kyle, do you want to kind of go over the overview of the credit real quick?
Yeah, sure. Thanks, Mike. And just one quick note on that last slide. I think it's important to note that the credit pertains not just to new products, processes, or techniques. It also pertains to improvements. And we'll touch on that a little bit later, but an improvement to a product or a process, a technique, or a formula would be making something higher quality, producing it faster, less expensive. Anything that is a technical improvement could also potentially qualify for the credit. So we're not just looking at new, or we're not just looking at products, we're also looking at improvements as well as processes. Just a little bit deeper dive on the credit. It's a non-refundable income tax credit. It's not just available at the federal level, it's also available in most states. I think 35 or 40 states have some form of research tax credit available, often functions slightly different than the federal credit. The whole idea is to reward businesses for developing or improving products or processes. And there are some carve-outs in the credit for qualified startup businesses that are maybe pre-revenue or in their first few years of generating revenue, where they can actually take those income tax credits and elect to offset a portion of their payroll tax credits. We primarily see the credit being a wage-driven credit. That's not always the case. There are some other expenses that can be captured, but usually that's the best place to start. We always want to know where the client or potential client, who their people are, what they do, and try to understand what their activities and projects are that might qualify, and then identify the people who are working on those projects to get a feel for to what extent they are involved with those activities. What we typically see is somewhere around a 7% effective credit on the annual spend of qualified research expenses. So $1 million of expense would generate somewhere around a $70,000 effective federal credit. That's not a hard and fast rule. It's just a quick way to estimate what the benefit would be. The credit can be carried back a year, can be carried forward 20 years. It's a non-refundable credit, so it's only going to offset income tax to the extent that tax is owed in that year. And any amounts that are not realized in that year, again, can be carried back or forward. A variety of industries apply to the credit. We do have several clients in the printing industry, or at least related to the printing industry. What we typically see with printing is a lot of process-related activities that meet the qualification for the credit. And we'll get into a little bit more of a definition of that here in a few minutes. So some of the triggers or some of the things to look for when identifying whether or not you might be able to pursue the credit. Who are your people? How do you have technicians, engineers, scientists? Do you have, even people with technical backgrounds, and what are they doing? You typically see anyone with a technical background or involved with a technical task or responsibility. There's likely some opportunity to pursue the credit, and there's likely something there to take a look at least. Again, developing or improving new products or processes, and any software. There's opportunities there depending on its purpose. Any equipment related items where this equipment is either purchased or designed and fabricated, there's always opportunities there in that scale up of that piece of equipment. What is it being used for? What kind of trialing is taking place with that piece of equipment? And that would not just be new equipment, but that could also be improvements to that equipment. And depending on the equipment itself, that may or may not be eligible for the credit. We typically see at least the wages associated with the people who are working on that piece of equipment as eligible, and potentially the equipment itself, but not always.
Kyle, can I ask a question? Going back to your first point where you talked about chemists, engineers, programmers, scientists. I just have to be honest, a lot of our clients, the first time we start talking about this, they end up saying, we don't qualify because we aren't scientists. And I just want to emphasize that they should look a little deeper than that, because even though they're not building rocket engines, there's still a lot of very technical people in the print organization. They're specialists. And we often find that those technicians are carrying the load on this R&D, but they're not engineers or scientists necessarily. Do you find that as well?
Yeah, Rick, that's a great point. There is no requirement for an employee to qualify for the credit, or perhaps to have their wages qualify for the credit, just based strictly on their title. It's all based on the activity. So who is that person? How do they spend their time? And how much of that is related to maybe improving a process or developing a process. That's the key thing. While titles maybe they matter a little bit, really everything's driven by the activity itself.
Yeah, and I might point on that too, Kyle, is this activity that Kyle is talking about can be new to you. It doesn't necessarily have to be new to the world. So, and then what I see a lot of our clients miss that we help them capture is it could be a new product initially, but then you can start improving on that product too. So it'd be like printing 1.0, and then you find a new process or a new technique that could be printing 2.0. So you can, a lot of our clients will make something, and then over the course of many years after that, they can make that existing product better. And all those activities and wages and expense qualify for the credit as well.
So I have a question. I assume that it can be multiple projects or processes. So if they have 3 different prototypes, it could be 7% of each of those, correct?
Correct, Teresa. Yeah, we're looking at a single tax year, and a project does not have to start and end in that year. It can carry forward into a year, or it can start in a year and then be finished in the subsequent year. But we're looking strictly at that at a single tax year for purposes of that determination and calculation. And again, it's not just one project. It could be, there's no limit, and there's really no bottom limit to the amount that has to be spent to pursue the credit, where we typically see somewhere around $200,000 annually would be maybe the bottom threshold. Maybe 150,000 would be the bottom threshold to want to pursue the credit. And some of that is impacted by any state credits that might be available. That threshold lowers a little bit if there's a state credit that's available to the taxpayer.
So when we talk about prototypes, oftentimes the printing industry is developing product in a proof fashion. We think it will look like this and roll out in this fashion, or it's going to be a 3-dimensional invitation, and here's a proof of what it would look like. We would refer to them more in the proofing process and less in the prototype. How strict or stringent is that definition?
Yeah, when you get involved in those, say, I would call it a trial run, essentially. What is the root unknown from a technical perspective that's driving that process? If there was a process and a design that you knew up front was going to work, you knew what kind of product it was going to produce, and you knew the quality of the product that it was going to produce, there would be maybe no need to run those proofs. And when you are going through that process, because there are those technical unknowns, you're entering into an area that you can evaluate for the credit. And more specifically, what you're evaluating are the costs associated with that effort. So the piece of the equipment itself is in some cases could be qualified, but most likely not. It would have to be some sort of pilot model or prototype piece of equipment. But the cost of the material that you're running that trial or proof with, you can capture that. The individual who's in charge of running that piece of equipment is the time that person is spending on that process, the wages paid to that person to drive and oversee that process could be captured towards the credit also. So definitely an area where there would be opportunity for it. So,
okay, if you get into the nitty gritty and you say faster, higher quality, I mean, all of our members are putting in newer presses to be able to compete with the competition, and they're all faster and better quality. Is that a R&D opportunity?
yeah, certainly. I mean, that's a good place to start. If it's a situation where you buy a piece of equipment and you plug and run with it, and there's really no unknowns, no testing, trialing, uncertainties, I would say there's limited opportunity there. For a new piece of equipment where you face technical challenges, startup uncertainties, unknowns, scrapped material, then you're entering into an area where there are those unknowns and uncertainties. There needs to be some sort of trialing or testing process, and you're getting into that area where you are conducting activities that would need the qualification for the credit.
Okay, one more question, and that's workflow. All of our industry constantly has to adjust their workflow for throughput so that it's more efficient. We're always working on continuous improvement, lean manufacturing, moving equipment around so that everything flows faster and better, is that an R&D?
The key yep, that is a great point. The key there is, are you evaluating those different options and ideas? And is the evaluation driven by some technical uncertainty? There might be financial uncertainty, which is good, but ultimately to qualify for the credit, there needs to be that technical uncertainty of, okay, is this new layout or design going to work? And is it going to create a faster process? And what are some of those unknowns? Again, from an engineering or technical perspective that are leading you to evaluate some different ideas.
Okay.
Yep, great question, Teresa. I also see there's 2 questions up in the queue. I'm kind of scared to click on that. I don't want to shut this whole process down, but do you see those, Teresa?
I do. And so one is related to our region. Remember, we talked about members all through the center of the country, from Minnesota to Texas, and one of them is specific to Missouri. And do they offer an R&D tax credit?
Yeah, so Missouri used to have a credit. They do not currently, unfortunately. I see another question up there. How many years back can a company claim the R&D credit? There is a 3-year statute of limitations to amend a tax return to claim the credit, either for carry forward purposes or for refund purposes. So as you're preparing for the 2022 tax filing season here in March and April, we would be looking back at potentially 2019 returns that were filed in the spring of 2020. And you have 3 years from the deadline of that 19 return to amend that return to capture the credit. The other question, could you address how R&D tax credits are handled with S corps? Yeah, so with a pass-through entity of partnerships would apply, Schedule Cs would apply also. Those credits that are captured or quantified by the business and claimed by the business, they pass through to shareholders pro rata based on their ownership in that S corp. So I guess one key note with those pass-through entities is that the credit will only offset tax liability for those shareholders to the extent that that business generated taxable income for that individual. So if you have additional income that's driving tax liability outside of the business claiming the credit will not offset that additional tax liability.
Any limitations? You know, we talk about S corps or C. Are there any that are limited?
There are some considerations. The biggest limit is that we run into typically is just what is your tax liability, and again, it's a non-refundable credit. So we see situations where there's a credit claimed of $100,000. It drops maybe $50,000 of tax liability off, and there's $50,000 left over to carry forward. That's maybe the simplest example of a limit. There really is no limit to the amount of expense that you can capture for the credit. It's just whatever the qualified spend is put into a calculation to drive the credit.
So for our Missouri members that are on the line, you say we can do both federal and state, but Missouri doesn't have state. So would 7% apply to the federal?
Correct. Yep, correct. And for those states with a credit, with a state credit, the applicable percentage there varies. So we would see in Indiana, we would see maybe 5 to 6%. Ohio, maybe 2 to 3%. Minnesota is a little bit higher. We usually see somewhere 4 to 6%. So it varies based on the state.
Okay. So it's worth it for our Missouri members to stay on the line and finish the webinar just for the federal aspect? Most
certainly. Yeah, most certainly. That's the primary driver when we get involved with clients is the federal credit. So that's typically the most lucrative. There's a few states that match the federal, but not many.
Yeah, and I'd like to point out too that you don't. It helps if you are in a taxable situation, But I would also say that don't let that deter you from looking at the R&D credit if you are not profitable yet, because as Kyle said, you can take that that federal R&D credit can be rolled forward for up to 20 years or until you use it. So we do have a lot of clients that, you know, oscillate in between profitability and not profitability, but they always still take that R&D tax credit for those years that they do become profitable. And it's kind of a nice war chest of credits to have there. When you do become profitable, you can knock out that tax liability. So I wanted to point that out as well.
Yeah, Mike, you want to skip ahead here and maybe touch on a few important slides? You can maybe skip this slide. So if anyone knows anything about the research credit, you'll hear about a 4-part test, and I'm not going to get into all the details here, but there's essentially 4 main criteria, each of which have to be met in order for an activity to be considered qualified. And a lot of these terms have already been thrown around here this morning, this afternoon. There needs to be an identified project that could be a product, a process, a technique, a formula, an invention that is either new or improved. There needs to be hard sciences or relied on, or the activity needs to be technological in nature. There needs to be uncertainty from a technical perspective, and there needs to be some sort of experimentation or testing involved. So in terms of the expenses that you can capture towards the credit, we've already mentioned wages. Those are box 1 W-2 wages paid to individuals who are involved in any kind of qualified activity in a year. Supplies, that could include a pilot model, a piece of equipment that you've designed, but most likely it's material that you're using in an effort to sell to a client in a trial situation. So running off those proofs would be an example where you're incurring the cost of whatever material you're trying to print. If you retain the services of a third party to help with testing or design, that contract research can be captured towards the credit. And then if you have any software where you're using the cloud, there's the potential to include those cloud computing costs also. And I guess maybe I'm not going to touch on all this, Mike, but one thing I do want to touch on that's probably most important, and for those of you who are familiar a little bit with the credit and have explored the credit for your business, one of the biggest obstacles I think that the printing industry and graphic arts industry faces when they claim the credit is one of the exclusions of the credit. And you see funded research up there, that's a big exclusion, but probably the biggest exclusion that people run into is the exclusion that the activity cannot be driven by aesthetics, or it cannot revolve strictly around just the appearance, the look, the taste of of that product or process. It can't just be to make something look good. So whenever we're working with a printing company or a company that's maybe even a flavor company, we want to take a close look, not at how something looks aesthetically, and not your efforts to make it pleasing to the eye, but what is the science behind that? So if you talk to, maybe it's a finish on a piece of paper. How do you make that happen? What chemicals, what process, what speed through a piece of equipment is going to yield that finish? And again, what is the science and the unknown associated with science that's driving some of that unknown on how to make that function? So even a flavor company, a company that's developing artificial flavors, they don't refer to flavors in terms of strawberry or banana. They talk chemicals and compounds to achieve that flavor. So again, that exclusion is probably the most relevant to your industry, and to the extent that you can relate that unknown back to the science behind everything, that's where you're going to qualify for the grant.
Yep, good point.
Mike, you want to touch on the just typical process for conducting a study for the research credit?
Yeah, absolutely. Yeah, we'll cover this, Kyle, and then maybe hit a couple of our clients that we already currently work with and maybe where they qualify, I think will be next. And then we can move on to cost segregation. So we can save Rob and his crew some time to talk about what they've got to talk about. So when we figure out, hey, you know what, we're qualified for the R&D tax credit. We've run some numbers and we've looked at your financial data and it makes sense for you to chase the R&D tax credit. The next part of the process is what we call field work. And that's where Kyle and his team, the people at McGuire Sponsor, will come out and visit your shop, and they will start to begin building your credit claim and documenting that credit claim in an IRS friendly format. So, and that consists of anywhere between 4 to 6 hours on site, talking to your key people that are doing the R&D credit, figuring out how do they do that, and then also gathering any documentation that we might need so we can bring it back to our tax teams internally and start substantiating your credit. So that process is anywhere in between 4 to 6 hours on any day that of your choosing. And there I said, you know, it's individual and or group interviews as well. If you have like a number of say technicians and there's 20 technicians, we can interview those all in a group setting as well to make it a little bit more efficient. So, and it's just, all it is just trying to document this process, understand the typical development cycle that you're using, and, you know, really starting to quantify the credit and then also document the credit, because those are two important things with the R&D that you got to get correct. Is number one's a calculation, and then number two, we've got to get the documentation. So that is that's why we have field work and kind of what we look to do during field work. You want to touch on this, Kyle, or should we leave this elephant in the room alone?
Well, we'll touch on it just very briefly. Starting in tax years 2022, at least as the tax law stands today, there is a 174 research expense amortization requirement, where those expenses that are related to research and development efforts must be amortized over 5 years, 15 if it's done outside the US. So one of the requirements to claim the credit under Section 41 is that those expenses must also be 174 expenses. There's additional requirements for 41, but what most taxpayers would see is that those 174 expenses are going to be larger than the 41. And again, as things stand today, it might change here in the future. We hope it does. There's a requirement to amortize those expenses over 5 years. Mike, we can we maybe skip this. And maybe, I don't know if there's any questions specific to your industry that you wanted us to touch on. I know we're half an hour into things here.
Maybe just maybe a couple examples that you've run into at printers would be just helpful. We have a list of examples. I know you guys do as well, for people as they're exploring this to kind of get a handle on, should I even start looking at it? But maybe just to touch on a couple of those and then we can move on.
Yeah, certainly. I mean, we had a large printing company based down in Kentucky. They use shrink wrap material that gets shrunk around different shaped bottles. So there was quite a bit of unknown regarding the acceptable thickness of that material, as well as the actual material itself and the physical properties of the material, on how that material would shrink appropriately based on the geometries of the bottle. So now the graphics themselves on that, on a sheet, they needed to also needed to be considered based on how the material would shrink, and all of those technical and how the thickness, the actual material itself, the temperature at which that needed to be applied to cause the shrink, just a lot of unknowns there. We often deal with finish. What's an appropriate finish, and how is that finish going to be achieved? It's based on the material, based on the process, based on the speed. Some other areas are just maybe the more obvious, where the speed, that's a big thing. Thickness of material that's acceptable. There's always those cost cutting measures with material, where our clients want to spend less on the material, so they're wondering how thin they can get a material and have it still be acceptable. Any kind of ink formulation is another area. Again, we're thinking about it in terms of the science behind the ink, not necessarily the colors or the aesthetics of what's going to be yielded by whatever process.
Yeah, and I'd say too, Kyle, that, we're seeing a lot of people come in, whether they're in the manufacturing industry, printing industry. We're getting a lot of inquiries about, hey, Mike, our end user client wants us to be more eco-friendly or be more environmentally friendly. Kyle, so would maybe people experimenting with inks that are more economic or environmentally friendly, and how those adhere to different types of paper, would that be something that these folks need to look into?
Yeah, definitely. And that brings up a good point, Mike. Any kind of regulatory testing that's required, especially when you're getting into alternative materials, anytime there's that regulatory testing that's required is a great indicator that there's something there that can be captured towards the credit. And that testing that is conducted is also something that can be captured towards the credit.
Perfect.
So quick question before you move on, and that is, there's a few things that are challenging to our industry these days. Of course, paper is one, so we have to look to alternatives, and you've mentioned an example for that. The other is workforce development. We don't have enough workers to fill the roles of those that need to produce the product. So we have to become creative at ways to make that happen. And sometimes that is a throughput process to make it more automated, or it's developing a workforce recruitment strategy to try and recruit workers. And would that apply?
Yeah, so Teresa, there needs to be a line drawn between your technical processes and technical unknowns and risks, and the business unknowns and business risks. So any kind of new strategy or process that relates strictly to your business and is not driven by the technical side of what you do would not be things that would qualify for the credit. So that's pretty important to note. While there might be some business and financial risk with what you're doing, that would be considered, that example specifically would be considered a business risk and a business process. But any automation driven by maybe lack of workforce, great opportunity to take a look at opportunities for exploring the credit. And another important note on that, if there's high turnover, if you have production people or managers, any training that is involved to bring them up to speed is typically not something that you can capture. Once those people know what they're doing and they're involved in trials, or they're involved in driving some of the maybe efficiencies or improvements, that's when you can get into an area where you can capture their wages.
Excellent. Thank you.
Perfect. All right. So Kyle, thanks for sharing that on the R&D. And if anybody ever has any questions about, hey, do I qualify, how to get in touch with us? Rick and Rob know how to get in touch with us. Teresa, direct your questions to them, and I'm sure they'll pass those on to us, and we'll be happy to help you. So with that, let's move forward and go on to our second topic today, which is cost segregation and fixed asset services. And I'll kind of cover this pretty quickly because it's a widely known concept out there, but it may not be to some of you. And I would say cost segregation is going to fit people who own their building, or perhaps they lease their building, but they are in charge of making improvements to that building to make it more workable for you. So you can own your building or you could lease your building. So basically what cost segregation is, it's an accelerated depreciation exercise where our engineers, our cost seg team will take a look at your building and split out every single asset component of that building, from flooring to ceiling tiles to electrical outlets to data cabling to parking lot striping, curbing. And those all have different depreciable lives that are classified, and they're set out by the IRS. So basically what cost segregation is, it's a method of accelerating that depreciation forward, because a dollar is worth more today than it is a year from now, 2 years from now. So it's a time value of money exercise. So that's all cost segregation. Now we have a team that specializes in this. If it's a load bearing wall, if it's a non-load bearing wall, how many lineal feet of flooring do you have in your facility? For instance, with flooring, that's going to be what the IRS calls 5-year property. So we could depreciate the cost of that flooring not over 39-year property, which is typically kind of how the financial consultants out there do it, and straight line depreciate your building. We have a team of engineers that come out and split all those out and drop them into the appropriate depreciable life buckets. So those buckets are 5, 7, 15, and 39-year property. This slide's got an example of what 5-year property is, and I think there's the 7 right there. Those are examples of what we can depreciate over 5 and 7 years. And there again, we have a team that comes in, an engineer, and we can look at your blueprints, we can look at your building if you've owned your building for a while, and help you split all these asset components out and dump them into the correct buckets. So there's examples of 5 and 7. Here's 15-year property, and that more to the outside of your building. As I said, the curbing, retaining walls, some landscaping, sidewalks, irrigation systems. All these components can be depreciated over a shorter life other than 39. So all we're trying to do is take that, as much assets as we can out of your 39-year property, and drop them into shorter depreciable lives. And what that does is that increases your depreciation deductions in the shorter life, which in turn should knock down your tax liability for that year.
Hey, Mike, you did a good job of breaking out the 5, 7, 15. Again, kind of related to printers, what we were seeing a lot in graphic arts design facilities. There is just a ton of things that you do to your buildings because of the manufacturing process rather than because it's a building. And I think that's another way to think about this. And things like humidification systems or even the high capacity electrical you have to bring into the building because you're a printer, or your reinforced press pads and the special chemical storage rooms. And I mean, it's a long list. And so again, I go back to your initial, if you own your building and you haven't looked at a cost segregation, definitely, let Mike and his team help you take a look, because it can be a significant tax cash flow savings if you move that depreciation up. And we've seen a big difference in these facilities that are graphic arts focused.
Yep, those are great examples, Rick, too. And then I would also say that I see in some of the work that we do in buildings across the country, maybe climate controlled. If you guys are manufacturing or printing in a climate controlled environment, I would say probably cost segregation is going to be something that you may want to look into. So great point, Rick. Thanks for bringing that up. Here's what makes a great opportunity in cost seg. So if you meet any one of these, what I call triggers, you may want to talk to your financial professional about, getting in touch and doing a cost segregation. I would say if you built a new building or you've acquired a building that's over 750,000 in purchase price, then I would say a cost segregation is going to be a big benefit for you. Now, say you lease your facility and then you renovate that facility to make it more conducive to your business operation, and you pay for the renovation. We like to see about 200,000 or more in renovation costs. A cost segregation is going to be a big benefit to you. And even though if you're in a 1031 exchange, those sometimes make a great opportunity for cost seg. So, Kyle, is there anything that I missed there?
No, I think that's right on. And Rick, you mentioned some of those additional areas that might apply, but even concrete pads for equipment. I mean, that's an area. The electrical systems that might go in, all of those are considered personal property if they're related to a specific process. So it's take a deeper dive into some of that.
Yeah, even ventilation systems, right, Kyle? You're ventilating some of these fumes from these inks and the ductwork and the dedicated electrical for that. They can be split out to a shorter life. So here's an example of this is a building that we did in Indianapolis a couple of years ago. And this is exactly the exercise of cost segregation. That building, as you can see on the bottom right, was $4.9 million. And the McGuire Sponsor cost seg team, this is how they split those assets out and their appropriate depreciable lives in the third column from the left. The maker's regular tax life. So you can see from that $4.9 million, there's only now 1.4 million left in 39-year property. Now we've got, $39,000 of 15-year property, and that probably had to do with the parking lot striping, sidewalks. And then look at the 5 and the 7 year there. We moved, of the 4.9, we moved $3.2 million into the 7-year life, which really helped. And that's one of the reasons why this firm decided to do a cost seg was that. And so now you're really depreciating almost 70% of your building within the first 7 years. So you're realizing that time value of money in 7 years versus strewn out over 39 years. So here's a great slide on what we see with different types of buildings. I think most of who we're talking to today, you're going to be on the bottom, the heavy manufacturing. I think from your total purchase price of your building, we will probably be able to move anywhere between 20 and 30% of the value of that building into a shorter life. So that's why I think it'd be, beneficial for anyone that's got a building that's over 700 grand to look at doing cost segregation. And here's some other, those are our top 8, top 9 buildings that we've done in 2022. Printing industry is going to be there again. It's going to be a great idea to do a cost seg. You guys will have a lot of asset components that we can move to shorter lives. So with that, this is Kyle and I's contact information with our phone numbers, our emails. I know Rick and Rob and Teresa and Ben, they know how to get a hold of us as well. So if you had any other questions about kind of what we went over today, or you need further clarification, Kyle and I'd be happy to help you, and just reach out and we'll get you the answer that you need to help answer your questions. So
hey, Mike, I was going to make one comment on cost segs. There can be a strategy as to when you might want to do a cost segregation study as well, right? I mean, if I am and I'm just thinking about if I'm a printer and I have multiple facilities,
Mhm.
maybe I want to do cost segregations on all of my buildings, but maybe I don't want to implement one with the IRS. One year I want to save it for a different year, just for maybe a tax planning strategy or.
Absolutely. Yep. Yeah, you can, we do cost segs for people that have owned their building for 15 years. They bought it or it was a new construction facility over 15 years and they never did a cost seg until now. There's what's called a 481 catch-up deduction to where you can take all that depreciation, say in 15 years and drop it into your current year, just kind of what like Rob alluded to is if you're wildly, and we saw a lot of this coming out of the COVID era where a lot of these businesses were wildly profitable and they were trying to figure out ways to knock down their tax liability. Well, say somebody's owned their building for 10 years, they probably more than likely did a cost seg back in 2021 or 2022 and take all that 10 years of depreciation and drop it into 1 year. So great point, Rob. Yeah, we typically recommend 15 years, back 15 years or sooner. If it gets any older than that, your building's starting to get almost fully depreciated. So I would say, 15 years or sooner would be great opportunity. Or if you've owned your building for 50 years and you just did a renovation maybe 4, 5, 6 years ago, it might be beneficial to do a cost seg on just the renovation since it's been so new. So great point, Rob. Thank you for bringing that up.
Rob. All right, so I will figure out how to share my screen here. And how's it looking? Good. Okay.
Good.
All right, good. Well, my name is Rob Yonkers, and I am with LB Carlson. We are a CPA firm. We are in Minneapolis, Minnesota. We have another office in St. Cloud. And we have worked in the graphic arts industry, I think, since our firm's inception. Rick could probably speak to this better than me, but I think I should probably know when our firm was founded, but I don't exactly, but I know it was the late 70s, early 80s. And I think our firm started exclusively as working with graphic arts companies back in those days. And we've since morphed to where we obviously work in other industries, but we're a CPA firm that does a lot of consulting for the graphic arts industry. And I think, we've probably been a member of the printing industry of Minnesota, which is now, I think, the printing industry of the Midlands for, I don't know, 40 years, Rick? I'm not sure. So I'm going to touch on a few topics, depreciation. And before I do that, I want to step back and talk a little bit about what Kyle and Mike talked about, because when I'm talking with my clients about tax planning or tax saving strategies, there's kind of your three buckets. You've got your tax credits, you've got your permanent tax savings, and then you've got your deferral tax savings items. Research and development tax credits would be a credit, and I look at it as a credit typically as that is your top tax saving strategy. And again, you can implore all these or, in different ways, but the reason why I look at that is because you get a deduction for what you spent, plus you're going to get a credit on top of that. Then I look at the second item of importance, which would be a permanent tax savings. And that's something where you're locking in something where you're not going to have to pay that tax later on. And then the third item, which is typically where depreciation falls, is a tax deferral. So we'll take depreciation now, and that means we're not going to get a deduction later. But I'm going to talk a little bit about some planning that I try to do with my clients where we lock in some permanent tax savings by using this deferral item. And that was part of the reason why I brought up that question to Mike on the cost segregation study as well. And we'll get to that when we get to the kind of the examples that I've got. And what I'm going to try to do is we're going to do a real quick overview of the technical items of depreciation here. And then we're going to move on to, and I'll probably spend some more time on just the examples that I have and the interplay and what we're trying to do there. So different things you'll hear when people are talking about depreciation. You'll hear bonus depreciation thrown out. You'll probably hear section 179, and you might hear regular makers depreciation. And a lot of you guys might be familiar with what bonus depreciation is. It allows you to write off 100% of qualifying assets for basically 2022. If you're working on that year right now and past years. But it's important. What you might want to know as you're looking forward is what's going on with bonus depreciation in the future. And it's gradually being phased out unless Congress changes something. So, and bonus depreciation is mandatory. I mean, one thing that maybe people don't realize is if we're preparing a tax return and you acquire assets, we're required to write off items using bonus depreciation unless we make an election to opt out of that. Qualifying property that's less than 20 years, qualified improvement property. So if you make improvements to non-residential real property, that's typically going to be eligible for bonus depreciation as well. There's no dollar amount of limit on qualifying property. So I'll talk about section 179 in a second, but sometimes people are like, well, why would I take one versus the other? Well, if you acquire a press and it's a $4 million press, well, you may not be eligible for section 179 that year, but you would be eligible for bonus depreciation. And I say it's an all or nothing decision. What I mean by that is, if we'll go back to that $4 million press example. If you buy a $4 million press, it's not like you can say, well, gee, I'd like to depreciate $2 million of that press using bonus depreciation. It's basically, you're either going to depreciate all of that press and take 100% of that as a deduction in that given year, or you're going to take regular makers depreciation and spread that over 7 years. But you can opt out of different classes of property. So if you've acquired, let's say you acquired a new press and you've acquired a lot of new computer systems, things that might be your 5-year property, you certainly could say, all right, well, I don't maybe want to take bonus depreciation on my press, but I would like to take bonus depreciation on all my 5-year property. You can certainly do that. Okay. Section 179. Okay, so that allows you to write off up to $1 million, $1,080,000 of asset acquisitions in 2022, and that money moves around. And here's a primary difference between bonus depreciation and section 179. Section 179 has a phase out that starts to occur at $2.7 million. So if I acquire $3 million of assets that are eligible for section 179, well, now the amount of section 179 deduction I can take in that given year, you guys go ahead and check my math, but that should be $780,000. So each dollar that you go above that $2.7 million, you're going to phase out of your ability to take that $1,080,000 of section 179 deduction. So if we go back to the example where I talked about the $4 million press, we're $1.3 million over our $2.7 million. So we're fully phased out, and the ability to take any section 179 deduction is out the window. Taking the section 179 deduction cannot take you into a loss position. Now, for S corporations or partnerships, you can go into a loss if you've paid guaranteed payments or wages to owners. But if you're a C corporation, basically your section 179 is going to take you down to zero, and that's how far you can go. Versus on the flip side, the bonus depreciation can take you into a loss situation. The section 179, again, a big difference between that and the bonus depreciation is that we can take any amount of depreciation on an asset. So let's just say that we purchased a used press and it was, $700,000. And we were doing our tax planning and we're like, you know what, I don't want to take all $700,000 of this deduction. I'd rather take $300,000 of this deduction because that's gonna land me where I'd like from a tax planning standpoint. Well, you certainly have that option if, you know, if you've got that addition plus all other additions that have you below that $2.7 million amount. You can take any amount from $0 to $180,000 and set your income exactly where you'd like that to be. Yeah, I mean, kind of like I was just alluding to. So I'll, with a lot of my graphics clients, and quite frankly, a lot of my clients in any industry, it just so happens that you guys are in a fairly capital intensive industry. We'll use the section 179 a lot for tax bracket planning. And when I get to my examples, which I think are on the next slide, we'll get into that. But part of depreciation planning, probably you need to talk about this de minimis safe harbor election as well. And I don't know if, you know, again, I don't know how much you talk to your tax professionals, but this allows you to write off any single item that you've acquired. If you, well, if you have an audit, it's up to $5,000 per item. And if you don't have an audit, it's $2,500 for any taxpayer. And what I mean by that is, and when I say any item, so I could be, you know, we'll just say at my CPA firm here, we are going to buy new computers for all of our employees here. And we spend $80,000 on 40 computers, but each one of those individual computers was $2,000. Well, I can make this de minimis election and I can write off all $80,000 of those and not even touch my section 179 deduction, you know, for qualifying assets. Now, the caveat on this is I do have to do this on my financial statements as well. So again, this is a planning tool, but if you have, you know, let's just say you're close to some bank covenant and you go, well, maybe I don't want to do this de minimis election. You don't have to do it either. You just need to, your tax and your financial statements are going to need to match for this. But it is, you know, any individual item that you can write off. All right, I hope my examples are big enough on the screen for you guys to see. But I just was going to run through a couple of examples here of some options that you'd have using these various items. And just so you know, again, a lot of times what I'm trying to do with my clients is if I have a client and, well, if they make millions and millions of dollars, and they're going to clearly be in the highest tax bracket, well, then a lot of times this discussion is really easy. It's like, okay, well, let's maximize the depreciation deductions because all of those deductions are going to be in, you know, the 37% federal, 37% federal tax bracket. But a lot of my clients, you know, they have the ability with the assets that they add and the income amount that they have, even if it's at, say, this $2 million level, to set where they're going to fall. And with a lot of my clients, my opinion is that we want to try to get their overall taxable income to somewhere around, and this is taxable income, and there's more complications in this than I've got in these examples, but basically try to get their taxable income to somewhere around a $350,000 range. And the reason being, and again, this is with my assumption on that is most of my clients are pass-through entities. So the reason why I picked that number is because below that number, they're going to pay federal tax at 24%. Above that number, they're going to pay tax at 32% or higher. So you've got a pretty sharp break there. So you'll see that's why, you know, in my opinion, we're going to want to go towards option 3. But, you know, in my example here, we've got the salary at $150,000. We've got the income before depreciation at $2 million. And there I've got my variation of my property and equipment additions, which total $2.5 million. So I certainly have a multitude of options. I mean, I can take bonus depreciation on everything. If I don't do an opt-out, I take bonus depreciation on everything. And I've got a $350,000 taxable loss, not income. So again, why would I not want to do that? Well, and again, what I'll always tell my clients is it's always your decision. But in my opinion, probably if this is what my client's individual income tax picture looks like, is they've got a $350,000 loss. Well, we've just taken a bunch of depreciation deductions at 24%, 22%, 12%, and 10%. And we've also probably taken off the ability to take any of their itemized or standard deductions. So we've wasted deductions. So that's where earlier when I first started my discussion, the reason why I do this balancing to a certain level is because that locks in some permanent tax savings in something that's typically just a deferral mechanism. Because if you look over at option 3, I've gotten to that $350,000 level that I've wanted to get at. And so I've probably over time, or I've probably permanently locked in for my client, assuming they're going to be in the highest tax brackets in the future, savings of could be, up to $70,000. Under option number 2, we've opted out of bonus depreciation. We've taken our section 179 and regular makers depreciation. This is really just in here just to show you that you can do that. And option 3, we're trying to get creative to get to that level. And what I've got in there, I've got option 4, and I don't have that on the screen. That's any combination that you want. I mean, because of where this, the amount of assets we've acquired, we're below that $2.7 million. We can take any combination of the section 179 amount that we want between, 0 and $1,080,000. Let's see. Second example, and the reason why I've got this example in here is really just to illustrate how you can use that de minimis safe harbor deduction. So you can see I've got some different variations on here, but in my 5-year property, I'm saying that I had 150 computers that I purchased for $2,500 each, and I should check my math again and make sure that's right. That is $375,000. So what I've done is I've said, okay, well, in option 3, I'm going to elect to write those amounts off on book and tax. And that is then going to give me the ability to use some of the section 179 deduction, because in my example here, I've phased out of it. And in option 3, what I've done is I've set that section 179, even though I could go up higher than that at $125,000 to get close to that $350,000 amount. So now I can't see Teresa, Rick, anyone. Are there any questions in the chat box, or should I just keep on rolling? All right, we'll just keep on rolling. Okay, cool. Well, that kind of finishes up depreciation. Next item I was going to touch on real quick is sales tax. And previously, I think I've done a hour-long presentation for this association on sales tax. We're going to keep this to probably 5 or 10 minutes. And sales tax is just the level of connection that requires you to have to file within a certain state. And traditional nexus does still exist. I mean, if you rent a facility in a certain state, if you've got employees there, you've got inventory on consignment equipment, you still do have a potential nexus issue. But the biggie is really economic nexus. And economic nexus now has been around for, I guess it's been 4 years now. And this states that if you have sales into a particular state over a certain level, then you now have nexus in that state, and you're required to register, collect sales tax, pay sales tax, all those good things. And as a general rule, that number is about $100,000. And I will admit that when this first came out, I certainly looked at this with some of my clients, but I was hopeful, because I think that $100,000 level is particularly low, that states would look at this, that someone would challenge this and they would increase these levels. But we're 4 years in now, and I guess I don't think the states are going to move. I think they're stuck there. And I think, we're here at the end of the year. Everybody on this call probably isn't a 12/31 year end, but a lot of you probably are. So it's probably not a bad time to take a look to see at states where you may have exposure, where maybe you should consider filing. At a minimum, I think you want to know where you have exposure. And the only reason why I say that is, we happen to do a fair amount of merger and acquisition work in our firm as well. And this has become a real hot topic in any of these merger and acquisitions. I actually was on a phone call earlier today with a client where we were looking at, okay, what are we going to do now? We should have been filing in 5 other states. We haven't, and it's been identified in the due diligence process. So, what are we going to do now? Are we going to go back? Are we going to strike a deal? What's going to happen? But this is something that it's going to be identified. It's going to come up. So I would say you want to look at it and at least quantify where you think you have, have potential risk. And quite frankly, if you're having a financial statement audit, I mean, your auditors may be doing this for you because they may be recording a potential contingent liability that you might have. And just to, not to make this sound like, okay, all I'm going to do is mitigate, or all I'm going to do is look at where I have risk. Part of what your process may be, though, is when you identify these potential states, you may look and see who these clients are, and maybe contact your clients and find out, have they been self-assessing tax, because that's a big part of the process as well. If I go back to the current project I'm working on, I think when we first identified this, I think we identified maybe, $6 million over of taxable sales that we thought might be a problem. And luckily for us, 3 or 4 of these clients were some fairly large. 3 or 4 of these customers were fairly large. We were able to identify clients of about $5 million that we reached out to, and found out that they were self-assessing tax. So, because I think one other important point here, sometimes you'll talk to people about sales tax and collecting tax, and it's not supposed to create any kind of competitive advantage or disadvantage. Because if I am buying from you my printer in Minnesota, and you don't have nexus here, so you're not charging me sales tax, well, I'm supposed to self-assess tax. There should be no competitive advantage. Any questions pop up again, Rick? Otherwise, that's about what I was going to touch on here. Okay. All right.
Mhm.
All right. Employee retention tax credit. This has been around now for a while, but it is currently, I'd say, still a pretty hot topic. The reason being, even though this is available for 2020 and 2021, you have up to a 3-year statute to file for any refund claims using this employee retention tax credit. And there's lots of firms popping up out there. I mean, if I had to guess, I'd guess everybody on this call is being contacted by, I guess I'll call them pop-up firms that are saying that they're experts at this employee retention tax credit. And the reason being because the dollar amounts are quite huge. I mean, looking at my screen here, so if you qualify for 2020 and 2021, it's up to $26,000 per employee. So if you have, 10 employees, you're already at potentially $260,000. And you can see if you have 50, it's $1.3 million. So the numbers are huge. And that's why, I think a lot of these firms are popping up. It's important to remember the way that you qualify. I'm going to say the easiest way to qualify, the most, I guess the easiest way to prove that you qualify is just a reduction in gross receipts. And for 2020, that was a 50% reduction in gross receipts when compared to the same quarter for 2019. So if I'm going back to 2020 and I look at, the second quarter of 2020, and I have 50,000 in sales, and I go to the second quarter of 2019 and I had $101,000 in sales, well, I'm more than 50% down. So I qualify for that given quarter. And for 2020, you continue to qualify until once you qualify for a quarter, until you are less, you come back to where your gross receipts compared year over year are less than 20% per quarter. And the other thing in 2020 and in 2021 is subject to government shutdown, that your business was fully or partially suspended. And that's what a lot of these pop-up firms are looking at and talking to people about, whether or not they qualify for these fully or partially suspended businesses. For 2021, that 50% goes down to 20% when you compare a quarter over quarter basis, and you're still comparing to 2019. And you've still got that government shutdown in there. And the other thing that 2021 does, it allows you to look back for a quarter to qualify. So I've had lots of clients that have qualified under the gross receipts example for a certain quarter in 2021. And that gave us the ability to go back and look at a second quarter. And we may not have qualified in that quarter by itself, but we did because we could use this look back provision. Okay. A lot of when we talk about government shutdown and examples, a lot of those are in IRS Notice 2020-21. They've got lots of examples in there as to what that means. So I would encourage everybody, if you're talking to, it doesn't matter to me if it's your CPA firm or if it's one of these pop-up firms that are out there, go to those examples in 2021-20 and see if you can make the fact patterns work. And the other thing that I will tell you that I am doing for a couple of my clients, because again, the dollars are huge, and I tell my clients, I don't think it hurts to talk to anybody, because in a lot of situations, the clients that I've talked to wouldn't qualify under a government shutdown, in my opinion. But what I've offered to do for a couple of my clients is I've actually called one of the authors of Notice 2021-20 and asked her if I could send her an anonymous set of fact patterns, and we could then have a discussion on whether or not she thought those companies would qualify. Now, she's not going to give me anything written, and some of it's going to just be her opinion. But again, these numbers are huge, and the reason why I guess I'll take a step back for a second here, and I'll say the reason why I caution my clients to go after these dollars under these government shutdowns, unless they're certain or can become quite confident that they qualify. Because like I said earlier, you have a 3-year statute of limitations to go after these credits. But what the IRS has done is they've given themselves, this is unusual because normally the IRS also has a 3-year statute of limitations. But for the employee retention tax credit, they've given themselves a 6-year window for the statute of limitations. So what I've explained to a couple of my clients is kind of a worst case scenario. And again, I think the employee retention tax credit, just so I can take a step back, I think it's a great program. I think if you qualify, you should absolutely be going for it. You should obviously be exploring the government shutdown and seeing if you qualify. But again, you want to make sure you qualify, because the worst case scenario is you hire one of these pop-up firms, and let's just say they get you $1 million of tax credits. You're going to pay tax on that. They're going to charge you probably 15%. That's 15-20%. Those are the rates that I've heard quoted out there. So you're going to pay them $150,000, and you're going to pay tax on that. Let's just say, if you're here in Minnesota, I'm just going to say it's going to be roughly 40% tax. So after your $1 million, you've paid them $150,000. You've got your $850,000. That's going to net you about $510,000, which is still absolutely a lot of money. And now let's say we go out a couple of years and the IRS comes in and they audit you and they go, well, gee, you don't qualify because you've said that you work under these government shutdowns, and we don't believe that you do qualify. And you lose to the IRS, you have to pay them back your $1 million. I don't think you're going to get your $150,000 back. And the other problem is you're not going to get your tax back now either, because you can't go back and amend those returns because you're outside the 3-year statute of limitations. So, and there's also the other thing, when I called and spoke with the person that wrote the notice, she had told me about this warning that they put out on third-party promoters that I'd read as well. But the IRS issued something in October. So, anyways, again, I don't want this to sound like the employee retention tax credit is something that's scary. I just think if you're going to claim it, you want to make sure that you're certain that you qualify and that you've got some strong legs to stand on. So, Rick, anything to add, comments?
No, I just would say I've experienced the same thing that you have, but clients getting hammered by these pop-up firms that you're talking about, saying, go for it, you got nothing to lose. Well, your example there, you do have a lot to lose. And I find it interesting, none of those pop-up firms will sign the returns, will stand behind it. And, you know, make your point is right on. If you qualify, and I do have clients that had legitimate shutdowns. I really did. And they were forced to shut down. We believe they qualified in a shutdown case. But then there was a bunch more that we didn't think at all came close, and the shutdown firms are saying they did. And so be careful of that.
Yeah. I mean, a couple other things, and again, just a couple other things that Rick just touched on it. I mean, I've asked my clients, hey, can you ask these people if they will sign the amended Form 941? So just in case everybody doesn't know, in order to claim they call it a tax credit, but you actually, different than the R&D credit where you get a credit against tax, this is refundable. So I file this on a Form 941, and the IRS sends me back a check from the United States Treasury that I'm able to cash, and I've got cash in my pocket. So so those amended tax returns need to be signed under penalty of perjury. So the question is, okay, will you as a third-party individual sign these tax returns? And a lot of times the answer is, well, no, your CPA, that's not part of our services. Your CPA can prepare the amended tax return and sign it. And in those cases, we've told our clients, we're not going to sign those on their behalf because we don't believe that you qualify under this. So, and there was one other thing that I just was going to talk about that I just lost. Can't recall what it was. Well, anyway, the Inflation Reduction Act, and I am going to spend literally 1 or 2 minutes on this, and then we will be done. There are not a lot of things for, I guess, what I will call small businesses in the Inflation Reduction Act. The 2 items I've got on top here are for extremely large businesses. If you look at your adjusted financial statement income and it's over $1 billion, you're now going to be subject to an excess or to a minimum tax at 15% of the amount in excess of that. And there's also a tax that they're going to charge on repurchase of public securities. And then there's a lot of energy related credits in there. So again, will I be looking at this for my clients? I certainly will, because if you own a home, if they own a second home, there's green home improvements out there that qualify. Individuals can qualify for purchasing electric vehicles. So a lot of my individual clients will certainly qualify, and that could be a lot of my individual clients that own graphics companies. But quite frankly, there really isn't anything of much in the act that affects small businesses, that you should be on the lookout for. So, and that concludes what I was going to talk about. So,
Okay, I don't see anybody has any questions outstanding on any of this, but I just want to thank everybody for hanging in there with us on this, and hopefully there's some good ideas in here for you to take advantage of.
And I should add, I've got my contact info, and I think
Teresa
will probably say this, but we're going to make the slides available to whoever wants them, would like to see them. So if anybody does have any, questions, comments, criticisms, concerns about anything that was discussed, you can certainly give me a call or shoot me an email. So
Great. Thanks, Rob.
Yeah. Thanks for having us, guys.
Great information. Thank you for putting together the details to share with the membership across both regions. I know there were a lot of great takeaways and information we all need to be aware of. So thank you.
Right, good. Thanks, everybody, and don't forget to ask questions if you have them.
Yeah,
Have a
we
great-
have just a few minutes left. If somebody does have a question, you can type it in the Q&A field or raise your hand and we can unmute you. And then, of course, if you think of the question after the program, don't hesitate to send an email and we'll pass it on, or send it directly to Rob or Mike or Kyle. And of course, we will make those slides and the recording available to you in the next couple of days.
Great, I don't see any questions, so I appreciate the time that everybody put into this, and thanks, Mike and Kyle and Rob in particular, in our panel as usual. So, and thanks Teresa for moderating.
Thank you.
Yeah,
Have a
thanks,
great
Teresa.
afternoon.
Thanks, Rick. Thanks, Teresa.
Have a great day, everyone.
Thanks, Rob. Take care.
Oh, wait, I see a question.
Oh,
Don't go yet.
okay.
Oh. This is, I shouldn't even say it. Happy to be a Carlson client. Somebody.
That's
Okay,
awesome.
thank you, guys.
All right, take care.
All right,
Have a great
bye-bye.
afternoon. Bye-bye.